Hi there, welcome to Nepi Invest. Stock picking is hard, and that's regardless of what type of strategy you do employ. Picking stocks for your portfolio is a difficult endeavor. And when you introduce a time period, you actually exaggerate the difficulty of stock picking. That's why I've never done this before. I have never looked at 1 year period and thought these are the stock picks or the stocks I think will perform better in that 1 year. And I did a video on Bell Potter's stock picks for 2022, and they did an absolutely horrendous job. And more than likely, if I did the same thing 1 year ago, I probably would have done an absolutely horrendous job as well. So I do think if you are focusing on a 1 year period or a specific time period, you do need a little bit of a different strategy than otherwise you would do for picking stocks in your portfolio. So I did think about my strategy, and I'll talk about my strategy in the next slide. But the other thing I did in this endeavor of picking stock picks for 2023, I did introduce one rule. And that one rule is I only had one rule that I wanted to follow in picking these stocks for 2023. And that one rule was sticking to companies that I don't already own or hold in my portfolio. And I think the main reason behind that is to decrease the bias because I do have a bit of bias when it comes to quite a few companies that are already owned because I do think that some of these companies have the chance to have an absolutely stellar 2023. So you won't see one single company in this list that are already hold. Now, onto the methods, the strategies that I did employ in deciding which companies to pick for 2023. And it all came down to companies that had an absolutely bad 2022, except for a couple. So I'm looking at signs of sentiment starting to shift. Not necessarily all these companies have that side, but I'm also looking at beaten down stocks, companies that have seen the share price fall 50, 60% in 2023. Research has shown and has been done on this in the past that sometimes the best performing companies in one calendar year were the worst performing companies in the previous calendar year, or on the flip side, the best performing companies in 2022 might be the worst performing companies in 2023. For example, energy companies were the best performing companies last year, and potentially in 2023, they will be the worst performing companies. Doesn't necessarily mean they will, but the probability suggests that if you pick companies that performed really well in 2022, more than likely they won't be the best performing companies this year. So I was looking for those companies who had seen a significant drop in the share price in 2022. And some of these companies' share price might have dropped because of reasons, sort of structural issues with the company itself. And that might be not a good strategy to follow. The other thing I was looking for was any sort of catalyst in 2023, but that is sort of predicting. I have no idea which companies might have a catalyst, but I did include one company in this list that I don't own, that I really, really want to own. And I think we will see a catalyst in 2023 that will lead to the share price of this company re-rating. So let's get onto the list and look at the 20 companies that I did choose for 2023. But before we get there, I didn't limit myself just to the ASX, but in the end, 19 of the companies are ASX listed, and only one company, although it's not really a company, it's more of an ETF, is or what is found on an overseas exchange. But there were two companies that I was going to include in this list that missed out, and they missed out for one big reason, and that reason is I bought some Volkswagen Group shares because the share price has dropped significantly over the past week, and I think it's really good value. And the other one was Taiwan Semiconductor Manufacturing Company, and I think that value or the value of that company is at the point where I do want to take a position in that company. And the other thing is Buffett and Berkshire Hathaway have been buying shares in that company as well, which might mean that there is good value. And I think there is good value, and I might be taking a position in that company soon. So I didn't want to include TSMC in this specific list. Now on to the first company in my list, and that is Platinum Asset Management, a fund manager focusing on value companies. And this the share price of this company has absolutely been decimated over the past 2 years, and it's been a funny journey over the past year because the share price has been consolidating or going sideways over the past 6 or 7 months. So it is showing signs that this downtrend we have seen the share price over a multi-year period is leveling off, and sentiment is trying to shift around. And I think we possibly will see the share price move into an uptrend as focus turns to more value plays than growth plays. A little bit surprising that the share price hasn't already moved into an uptrend. I think there is good value here for this company. That's the other thing. And also a nice dividend yield. And when you do look at the funds under management, I think in the last month they did rise. So a potential turnaround play for Platinum Asset Management. This is probably one of the lower confident players I do have within this list. In fact, I was going to get rid of this choice, but in the end, I decided to keep this to keep Platinum Asset Management within this list. So this is probably towards the bottom of my confidence range in terms of which companies I think will increase, which companies I think might go sideways or decrease during the next year. Integrated Research is definitely showing signs of turning around. We did see a nice little rally in the share price about 1 month ago, and then the share price has sort of gone sideways. We didn't see a lot of selling after that rally, and it does look like potentially the bottom has been reached in this company. And if we do see the share price get above 62.5 cents, which was a highs back in August, that would be a fairly bullish sign. Also, this company has seen significant decreases in their revenue over the past few years. The valuation of this company is quite low, so a lot of negative sentiment has driven the valuation down to levels where I think the risk reward is in favor of the reward instead of the risk. So this is definitely just playing probabilities. If you pick 20 of these companies, there is a chance a few of them will keep on going down, but there's also the chance that quite a few of these sort of companies will see significantly higher share prices in a year or two. So I'm just hoping that Integrated Research will move into an uptrend, and we'll also see that catalyst that I'm looking for, that profit upgrade or better than expected financial numbers that will lead to a significant re-rating in this company's share price. Another company that looks like it has seen its sentiment shifting around is Avita Medical. And just like Integrated Research, I need to see, for me to be confident about that shift in sentiment and a change in the trend of the share price, is I want to see the share price move above a resistance level. And for Avita Medical, that resistance level is around about $2.30, which was a high back in August. It tried to get above it towards the middle of November and struggled and did pull back. But it does look like, just like a few other companies in this list, share price is now going sideways. It's consolidating, and share price wants to move into an uptrend. And all it needs is one thing, and that is a catalyst, a positive catalyst. One company I've been very close to actually taking a position in and including in my portfolio is Domino's Pizzas or Domino's Pizza. We have seen the share price drop from 160 odd dollars all the way down to about $52 in 1 year period from September 2021 to around October 2022. Now, I actually did try some Domino's pizzas the other day. And every 2 years, I try Domino's pizzas just to see if they improve in quality. And I came away quite disappointed. But that does not mean this is not an investable company. Just because of the management, because of the tech they've introduced, just because I don't like the pizzas, I prefer other pizzas. It doesn't mean other people don't prefer Domino's pizzas. So the growth in this company and the potential growth, more importantly, over the next 5 to 10 years, sets this company up for being a long-term pick. So the question is around this company, whether we will see a significant growth in share price over the next year. That's probably up in the air right now, but it does look like the sentiment is shifting from a fairly highly negative during most of 22 into possibly being positive during 2023. And the other thing I have heard this company mention a lot in podcast, my core on Ausbiz, those sort of things. I have seen Domino's Pizza mentioned a lot as being a value play right now. Even though the PE ratio is quite high, I think a lot of analysts know this company has significant potential growth in the future. And that's why the PE ratio is high. And that's why I think you might see more money coming in, taking positions in this company. Just like Platinum Asset Management, I do have low confidence on this one, DDH1 Drilling, and I was almost going to exclude this company as well. And I probably would prefer to buy this for the longer term, say a 5-year period, than just a 1-year period. However, it does look like the share price is trying to move into an uptrend. It does look like sentiment is shifting for this company. And if the share price does get above about 93 cents, which was the last high we saw about a month ago, I do think there is potential we might see an uptrend in the share price for this company. So this is just a potential momentum play. And if we do see the market rally, I think this is one of those companies which will see our share price moving into an uptrend. So this is just a momentum play. Unlike a lot of the other companies that I've chosen in this video, whose share price have been in well-defined downtrends, it does look like share price of those companies are trying to move into an uptrend. Sentiment is trying to shift. Allkem is a completely different story. Share price has been an uptrend for a while, and we have seen a significant pullback in the share price over the past about month and a half or so. Share price reached about $16.50 in the middle of November and has pulled all the way back to less than $11 or around $11. And I do think there is potential. We have seen a bottom in the share price of this company and potentially other lithium companies as well. So this is simply me playing the bottom. And this is a risky play. We saw this happen back in June and July, where the share price did fall below the trend line. And this is sort of a medium to long-term trend line. And that's why this is a risky play. I'm just thinking that the share price might rally from here. There might be a lot of buy the dip investors out there, particularly those who are really bullish on lithium moving forward. So that's the only reason I have included Allkem on this. I am bullish on lithium in the short term. So I think there is potential that Allkem, Pilbara, Core Lithium, all those sort of companies, Lake Resources, might all go on another rally during 2023, particularly if we do see lithium prices start increasing again. One company I had no intention of including in this list was Pact Group, PGH. Share price is in a well-defined downtrend, and there's no signs that this downtrend is coming to an end. You can just see the gap between the two moving averages I have here. Actually, I've included 3 moving averages, the 200-day, 100-day, and 50-day, and that red area is the area between, or that red shaded area is a distance between the 100-day moving average and the 50-day moving average. When you see that area starting to tighten and squeeze, that is telling you that the share price is starting to consolidate, and we don't see any of that when it comes to Pact Group. The nearest we did see that was happening in August, but then the share price pulled back a fair bit. So the share price of this company just wants to keep on going down. And the share price right now is at $1. This is a company I have held in the past, way back in 2015 or something. Just after they did list on the ASX, the share price was in a really nice uptrend. The first negative announcement from the company, I sold out completely, and the share price has been dropping ever since then. Well, not ever since then. We have seen a couple of rallies in the share price. But then I had a look at Pact Group financials, and I really think the market is being overly negative when it comes to this company. So not this year. I think last year, the previous 2 years, they had profit around $80 million. Profit pulled back a fair bit this year, probably because of margin squeezes, squeezing margins, margin pressures, that sort of thing. And as those pressures on margins play out over the next year, I think margins will increase for this business. Revenue has kept on climbing at a fairly slow rate. And there is that potential that profits will go back up to, say, 60 to 80 million in the next financial year. Maybe not financial year 23, but then financial year 24. And before that happens, before they show those results or reveal those results, I think the market will become aware, and there is potential that the share price of this company has a pretty significant bounce in the second half of this calendar year, because right now the market cap of Pact Group is something like $350 million, which means if they go back to a profit of $80 million, the PE ratio of this company is 4. So this is just a value play, even though when you look at the chart, it's absolutely ugly. So I'm really thinking about the second half of 2023 and hoping The worst thing you can do when you're picking stock is to hope. And I'm just hoping that the trend and the sentiment in this company shifts from highly negative to positive in a fairly short period of time. One thematic I have gone for in the next few picks is a rebound in tech, particularly in the second half of the year. And I do think we might see a pretty good rally in tech companies, even on the ASX in the second half, particularly if we are confirmed to have gone into recession in the United States. So the best time to really go all in on equity markets is when we're in a recession, not when we're coming out or we're confirmed to be out of the recession, is when we're confirmed to be in the recession. So I think there is potential if we do or are confirmed to go in the recession in the United States, say in June or something like that, that's the time to really think about going all in companies like Megaport and the next few companies I'm going to show you. The other reason I picked Megaport and the next company is because of the overall love these companies have in fund, or for fund managers have for these companies. Remember, I've talked about this before. 1 year ago, Megaport was the most popular company among picks for 2022. This was done via Livewire. They interviewed quite a few fund managers, and the top pick was Megaport. And the share price thereafter fell during 2022 from about $21 all the way down to a low of $5 in June. So in 6 months, the share price decreased 75%. And it doesn't look like the share price is trying to consolidate, but there's a lot of volatility simply because this is not a profitable company. They have released a couple of negative Appendix 4Cs as well. You can see that in October, the share price fell a lot in 2 trading days because of a negative Appendix 4C. But I just think based off the fact that a lot of fund managers absolutely love this company for the potential, this company is not operating cash flow positive, not profitable just yet. They do think once they do become profitable, this company will become highly operating cash flow positive thereafter or soon thereafter. So I think that's the reason why I think I've chosen this company is just the potential for the rebound because of how beloved this company is among fund managers, particularly small cap fund managers. Similar to Megaport, Xero is in that area where it's a much beloved company among fund managers. I keep hearing about Xero. The other day I listened to a podcast. I think it was the Ausbiz, the core. The 2 analysis on that particular episode absolutely love Xero. Both of them said this is the best tech company on the ASX. I'm not sure if I agree with them in regards to that. And they said the share price lower than 80 cents or $80, not 80 cents, $80. This is an absolute still. And the share price has dropped a lot during 2022. So at the start of 2022, the share price was about $145, and now the share price is about 70. So share price has dropped by more than 50% over the past year. So this is another one of those companies where I think in the second half of 2023, we wouldn't be surprised to see a significant bounce as the market and the sentiment in tech companies starts to shift. Now and this is sort of in the same realm as Megaport and Xero, except I wouldn't call this a beloved stock among fund managers. In fact, I'd probably say it's the exact opposite. This is a hater stock among almost everyone, it seems like. Share price of this company has absolutely fell off a cliff over the past 2 years because of really bad performance from the company itself. In fact, the share price at one point got as high as $12 just after they IPO'd, and right now the share price is around 62 cents. But it does look like since June, share price is trying to consolidate. Share price is going sideways. So the low in the share price was actually in October, just slightly lower than share price low in July. And the next low was a little bit higher than the low we saw in October. But we need to see, or I would like to see, a higher high, and that's after the higher low. And once we get that higher high, which would be above 75 cents, that would make this company looking even more interesting. However, there is still a lot of negative sentiment in regards to this company, a lot of resistance moving forward because share price has dropped a lot. And hopefully, a lot of that resistance are those investors who have sold out over the past 6 months as the share price goes sideways. So I'd probably say the longer the share price of this company can go sideways, the better. And then the company can release a positive announcement, say a profit upgrade, something like that. And that would be the catalyst for re-rating in this company's share price. So just the valuation right now for Nuix and the fact the share price is going sideways leads to me to think maybe we have reached a bottom and now could be the time to be thinking about taking a position in this company for the short to medium term. Doug is another one of those companies that look like the sentiment is starting to shift. And we are at a really interesting point right now in terms of the share price, because if you go back to 2000 or 2000, if you go back to around about, say, middle of August, the share price reached 62.5 cents, and then we did see the share price pull back. In fact, the share price went to a low of about 33 cents in early November. You can see a one-day candlestick with a very long tail. And that is telling us there's a lot of buying coming in when the share price got down to less than 40 cents. And the share price has rallied about 50% from that point. And right now, the share price is struggling to get above that previous high we saw in August. And if the share price can get above 62.5 cents on good strength, so high volume, that would be confirming that the share price the trend in the share price of this company has turned to positive, and sentiment has shifted from negative to positive as well. So I'm not sure exactly which way this is going to play. So this is all based off potential that the share price will get above 62.5 cents in the near future. When I say near future, I'm talking about 3 to 6 months. And then I think the share price can go on a rally, particularly, again, just like most other companies in this list, if they release a positive announcement, which would be a positive catalyst. So those are the things I'm looking for with each of these companies before I even think about including these companies in my own portfolio. Just like Pact Group, I had no intention of including EROAD in this list because the share price is in a well-defined downtrend, just like Pact Group. Share price has no signs of getting out of this well-defined downtrend. Share price keeps on decreasing, and right now the share price is at probably an all-time low for this company at around about 85 cents or something like that. So no signs of a shift in sentiment, no signs of a shift in trend. But then I had looked at the valuation of this company, had a look at the financials, revenue, and that sort of thing, and I think the market is getting a little bit too pessimistic about this company right now. And when the market is getting a little bit too pessimistic, that could be the time to think about taking a position in a company, because if they, and they're also mentioned, I had a quick look at some of their commentary from the last results, and they are mentioning about decreasing costs as well. So there is that potential that this company can become profitable sooner rather than later. And I think if this company releases any sort of positive announcement, a positive catalyst, we will see the bottom of the share price and the share price go on a significant rally. However, in saying that, with the negative sentiment and with the significant drop in the share price over the past year, and when I say significant, the share price has dropped from over $5 to that current share price of around 85 cents. And that's in 1 year. So a lot of negative sentiment. A lot of investors have bought this company at a much higher share price, and that is resistance. So I think I wouldn't be surprised to see the share price go sideways for a long period of time. And then what I expect maybe in the second half of this year, a really good rally in the share price if we see some positive news from the company. And the same is true for City Chic. I should probably not include this company. They just keep on releasing really negative financial news, and the share price just keeps on dropping. In fact, the share price has dropped from around about $5.50 to $6 all the way down to less than 50 cents. I heard this company mention on, again, the Ausbiz, the Call podcast or video about 1 month ago. At that point in time, the share price was 75 cents. And even then, they were a little bit wary. There would have been a lot of investors who did see that significant drop in share price towards the end of November. Share price went from $1.25 to 75 cents. And they probably said, well, pretty good value here, even though the share price did fall through a fairly strong support level. And then the company released further negative news, and the share price had dropped even further. And we have seen massive volume coming in over the past month and a half. That's not positive news at this point in time. If we start to see even more volume coming in and the share price starting to rally, and that could be the sign of good times ahead for City Chic. So wouldn't be surprised to say this being the end of the downgrade cycle for City Chic. And the valuation of this company is really intriguing right now if they do turn around. Now, this is not my favorite retail play at all. So this would be just that this is the bottom in City Chic share price, and there will just be a significant bounce in the share price over the next year. So that's all I'm doing is hoping. So another one of these hope plays in this list. Another hope play is Adore Beauty. I'm not the biggest fan of this company. However, the share price looks like it might be bouncing off a support level, which is portrayed by that dashed line at around about $1. And round numbers like $1, 50 cents, $10, 10 cents are pretty natural resistance and support levels because for some reason, investors love buying and selling at round numbers. So if you go back to June, July of this year, the share price went sideways just above $1. So that confirmed that $1 was a really good support level. Then the share price bounced. In fact, the share price went from $1 all the way to a high of $2.25. So that's a pretty significant bounce, increasing volume as well. So I'm always wary about those sort of really short bounces in the share price, even with a larger volume, because of all that resistance of all those shareholders who bought at higher prices over the past year or the previous year. So no doubt a lot of that volume was just those investors who saw the share price rally and decided to sell out of their position of this dog stock. And the share price has tested $1 again about 1 week from when I'm doing this video, and the share price has bounced off $1. But that bounce has been fairly weak. So that's one thing I am wary. And if the share price does fall through $1 on strength, that would be a very bearish signal moving forward. So my play with Adore Beauty is that the bottom has been reached at $1, and I'm just buying in at just above that pretty strong support level. And then hopefully some good news flows through from the company and the share price rallies from here. And hopefully the share price rallies back up to $2.25 by the end of the year, maybe even more than that. And that's the main reason I've included this company within this list. Similar to Adore Beauty, Dust does look like it's just above a nice little support level at $1.62. That was the lows we saw back in June, and then we saw a nice little rally in the share price of Dust. Now, even though that's similar to Adore Beauty, there's a lot of differences between Adore Beauty and Dusk. In fact, I definitely 100% would prefer Dusk over Adore Beauty because Dusk is profitable. They have a dividend. In fact, the dividend yield is really nice. They have a really low valuation in terms of their financials. So I think this is good value. Anything less than $2, I think, is good value. And right now, the share price is just above that nice little support level at $1.62. And the very fact that this company has a pretty good dividend yield should keep sort of not a lid. What's the opposite of a lid? Should keep a floor on the share price dropping any further than $1.62. So the reason I've included Dusk in this list is just because the share price is just above a nice support level, and I don't think the share price could fall much further than here. Now, most of the companies within this list, I'm just looking at the charts. So it's all based off sentiment starting to shift, the trend of the share price, that sort of thing. Some of these companies, it's all about the value, and I don't think the valuation of the company can get much lower. I could be absolutely wrong. But I just wanted to include one company that I don't own already that I really, really want to own. And I think this company has the potential to hit a very important inflection point and really start growing at a significant rate, not only this year, but over the next 5, 10 years. It also has one of the best moats on the ASX, and that is Audinate. If you look at the valuation, the market cap of this company is quite high, something like 500 to 700 million, because fund managers know about this company. They know about the moat, and that's why the share price struggles to get any lower than, say, $5. And that was the low we saw back in June. I should have taken a position back then because I am following this company and I want to take a position. And I think what I might do with a few companies that I really want to take a position, but I've just held off, is to just nibble. I like this strategy of just taking a nibble in that company. And then if share price pull back, you add to your position. And if the share price runs after you take a nibble, that's okay as well. So that's what I might do with Audinate. But I really like this company moving forward. I think there is that potential that this company will release a really, really positive catalyst announcement during the year, and we will see the share price rally on the back of that announcement or that news flow. A company I have owned in the past, then sold to take profits. Then I thought the valuation of the company was way too rich, and then the share price has dropped from that valuation. I think the share price reached something a high of about 40 to 50 cents, and we have seen the share price drop from about 40 cents down to a low of about 10 cents, which was reached in June this year. And it does look like, just like many other companies that I've chosen in this video or within this list, the share price and the sentiment is starting to shift. And this is one of those companies that I think has the potential to become significantly bigger over the next 5 years. So that's the main reason I've chosen Accelsior right now. Even though I do think it's a good long-term play, I think there is potential. The share price of this company can go on a run, particularly if we see a shift in sentiment within the tech sector. Last ASX company in this list is Symbio. I actually did a video on Symbio because they did release a fairly negative trading update. This was a profit downgrade about a week ago, and the share price absolutely fell off a cliff. Share price dropped from about $2.60 down to $1.50. And over the past year, the share price for Symbio has dropped from about $6 to $7 all the way down to $1.50. So the valuation or the market cap of this company is at really interesting levels. If you don't know who Symbio are, they're the old MyNet phone, and I have always been following this company, but I've never taken a position in MyNet phone or Symbio until potentially now, and that's all because of the valuation. I also think right now, potentially the market is overreacting with this sell-off, and there is that potential, particularly in the second half of this year, that we might see a really good bounce in the share price for this company, particularly if instead of issuing profit downgrades, they start issuing profit upgrades, that sort of thing. I think that's probably unlikely, but even if they don't do that, I think there is a chance that the bottom has been reached, if not now, then soon, next few months or so, and then we will see a nice little bounce in the second half of this year. So again, this is just a hope play, really playing the second half of 2023. And the last stock pick is actually not a company, it's an ETF, the ARK Innovation ETF. And I did have trouble finding some US companies. I didn't really find anything I really liked because I do own quite a few American companies, some of the biggest companies, and they would have been my choices, but I already own them. And because of that rule, where I don't want to include any companies I already own, I was really trying to find a company that I wanted to include in this. So I did have a couple of choices: Under Armour, Unity, Nvidia, those sort of things, but I'm just holding off right now in choosing those companies. So I decided instead of choosing a one company, I'll choose an ETF that has quite a few of the companies within the ETF, and that's ARK Innovation ETF. The share price of this ETF has absolutely fallen since November last year, fallen from about $125 to current $30. So 75% drop in the share price or valuation of this ETF. And there's no sign that the downtrend is coming to an end soon. So just like Pact Group, E-Road, there's no signs, unlike some other companies I've shown you in this video. But I do think we are getting to the point where tech companies might go on a rally. If not within the next 3 months, definitely in the second half of 2023. So I think this is a second half of 2023 play, and just hopefully it doesn't fall much further from here. When I originally did this video, I titled it My Stock Picks for 2022, and then I started recording the video, and then I realized, I got the year all wrong. So in the next month, we're going to keep on calling this year 2022 until we get used to this being a new year, 2023. So I hope you've enjoyed or agreed or disagreed with some of my stock picks for 2023. If you have a different opinion, if you think I'm absolutely crazy with some of my picks, leave your thoughts, your comments in the comment section of this video. And tomorrow I'll be going through all your stock picks. Not sure exactly how I'm going to do it because I do have quite a few picks there, but there is definitely some companies favored over other companies. Maybe that's how I'll do the video, because there are 2 companies that were chosen 4 times by viewers of this channel. So wait out for that video, which I should release on the 3rd of January. I do have a night shift on the 2nd, so hopefully I won't be too tired to release that video. Anyway, other than that, I am not a financial advisor. So even though these are my stock picks for 2023, it's all for entertainment purposes. I could be completely wrong. These could be the worst stock picks ever. So don't put any confidence. Don't go out there buying all these companies just because they're my stock picks for 2023. I don't think it's a good strategy to pick for 1 year and that's all you're going to be looking at. So I'm just doing this for fun, just doing this for entertainment purposes. And if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.